Did you know that Warren Buffett, the legendary investor, is sitting on a staggering $189 billion in cash? Berkshire Hathaway's cash reserves have ballooned to an all-time high. This unprecedented amount is making waves and raising eyebrows in the financial world. Every year, Buffett's annual Berkshire Hathaway conference attracts immense attention. Investors and analysts hang on to his every word, trying to decipher his thoughts on the economy. This year, however, Buffett's message was clear and rather alarming. His actions suggest that he's preparing for a major economic downturn. Why would the greatest investor of all time be so cautious? The answer might lie in the staggering amount of cash he's holding on to. Typically, when investors hesitate to spend their cash reserves, it means they don't see any worthwhile opportunities in the market. In Buffett's case, this hesitation could be a sign that he perceives the market as overinflated and ripe for a crash. To put things in perspective, Berkshire Hathaway's $189 billion cash pile is not just idle money. Most of it is invested in short-term U.S. Treasuries, which are currently yielding about 5.4%. Yet Buffett has stated that even if these yields were as low as 1%, he would still hold on to this massive reserve. This indicates that his caution is not about seeking higher returns, but about protecting capital in an uncertain market. Berkshire Hathaway's cash pile. Why is Buffett, the world's most famous investor, choosing to hold such a huge amount in these conservative investments? Buffett's decision to keep this enormous cash pile signals a lack of confidence in the current market. Typically, investors like Buffett deploy their cash when they see valuable opportunities, but with $189 billion just sitting there, it seems Buffett isn't finding anything worth buying right now, or he's holding on to buy the dip. Berkshire Hathaway's cash reserves have been growing steadily. Just a few years ago, it was around $120 billion. Now it's nearly $189 billion. And it's not because Buffett's lost his touch, it's because he's waiting for the right moment, a moment that hasn't come yet. Why not spend it on stocks or acquisitions? Well, Buffett's approach is famously cautious. He's known for waiting until he can buy great companies at fair prices. Right now, seems like he thinks the market is overvalued. The current cash pile includes cash equivalents in short-term U.S. Treasuries, which are considered safe and liquid. This means Buffett can quickly convert them into cash if he spots a golden opportunity. But the fact that he's holding on to these treasuries instead of diving into the stock market speaks volumes. The S&P 500, which lists 25 of the largest companies in the U.S., is filled with potential investment opportunities. Yet Buffett's reluctance to invest in these companies suggests he sees an overinflated market. And he's not alone. Many financial experts are wary of the current market conditions, fearing a bubble that's ready to burst. Buffett's perspective on market valuation. Ever wonder why Warren Buffett, the Oracle of Omaha, is holding back from investing? It's because he sees the market as seriously overvalued. But what does that mean for us? Buffett's approach has always been about value, finding great companies at fair prices. But right now, he's not seeing many good deals out there. With 500 companies in the S&P 500, you'd think there would be plenty of opportunities. Yet Buffett's Berkshire Hathaway is sitting on a $189 billion cash pile, suggesting he's not finding anything worth investing in. The S&P 500 is at record highs, and the market capitalization of these companies is staggering. In fact, the total market cap of the S&P 500 is over $38 trillion. Yet Buffett's not buying. Why? Because he believes these valuations are inflated. Historically, when markets are overvalued, corrections follow. Buffett's history shows he's a master at recognizing these bubbles and waiting them out. Take a look at the Buffett Indicator, which compares the total market cap of U.S. stocks to the GDP. Right now, this indicator is around 199%, meaning the market is nearly twice as valuable as the entire economy. That's a huge red flag. Historically, whenever this ratio has surged, it's been followed by significant market downturns. Buffett's reluctance isn't just about market bubbles, though. It's also about strategic patience. In past economic cycles, Buffett has shown remarkable restraint, waiting for the right moment to invest. For example, during the dot-com bubble in the late 90s, he stayed on the sidelines while others rushed in. When the bubble burst, Buffett was ready to buy at bargain prices. Right now, his strategy is the same. He's waiting for the market to correct itself for prices to come down to more reasonable levels. This cautious approach is backed by solid statistics. For instance, the Shiller PE ratio, another indicator of market valuation, is currently about 35, far higher than its historical average of 16.8. This suggests that stocks are overvalued and could be due for a correction. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Buffett's actions speak volumes. By holding on to his cash and waiting for better opportunities, he's signaling that he believes the market is overheated. And when Buffett speaks, or in this case acts, the financial world listens. His strategic patience and a keen eye for value make him a trusted figure in investing. So when he's cautious, it's wise for us to take note. The Buffett Indicator. Have you ever wondered how Warren Buffett gauges the market's health? One of his favorite tools is the Buffett Indicator, and it's flashing some serious warning signs right now. The Buffett Indicator is a simple yet powerful metric. It compares the total market capitalization of all publicly traded companies in the U.S. to the country's GDP. Think of it as a way to measure how the stock market's value stacks up against the real economy. Right now, this indicator is at a staggering 199%. To put that in perspective, this means the stock market is valued at nearly twice the entire economic output of the United States. Why is this important? Historically, whenever the Buffett Indicator has climbed this high, the market has experienced significant downturns. During the dot-com bubble in 2000, the indicator peaked at about 146%. Before the 2008 financial crisis, it reached around 137%. Both times, these high readings were followed by major market corrections. The current U.S. GDP is approximately $26.7 trillion, while the total market capitalization of U.S. companies is around $53 trillion. This mismatch is a classic signal of overvaluation. When the market is worth so much more than the economy itself, it suggests that stock prices are inflated beyond their true value. Buffett himself has said that the Buffett Indicator is probably the best single measure of where valuations stand at any given moment. Right now, this measure is screaming that the market is overheated. If history is any guide, such high levels of the Buffett Indicator often precede a market correction. The significance of this indicator can't be overstated. It's not just a random number. It reflects the collective value investors place on publicly traded companies compared to the actual economic activity. When this value is disproportionately high, it usually means that investors are overly optimistic or speculative, which can lead to a bubble. At the height of the dot-com bubble, many tech stocks were valued at astronomical levels without any real earnings to back them up. When reality set in, the bubble burst and the market crashed. The Buffett Indicator helps to identify these kinds of overvaluations. Interpreting Buffett's warning. Did you know that Warren Buffett, one of the world's most successful investors, has openly admitted he can't find any good investment opportunities right now? That's right. Despite having $189 billion at his disposal, Buffett is holding back. What does this mean for us? During the recent Berkshire Hathaway conference, Buffett's message was clear. The market is too risky right now. He stated there are no attractive investments available, which is a significant red flag. Buffett is known for his keen eye for value, so when he's cautious, it's time to pay attention. Let's dive into the details. Buffett's reluctance to invest is a strong signal that he expects market corrections. Historically, Buffett has always looked for undervalued opportunities, but today's market doesn't seem to offer any. This is echoed by many financial experts who agree that Buffett's actions reflect a bearish sentiment. Consider the numbers. The S&P 500, a key indicator of the stock market's health, has been soaring. But many experts, including Buffett, believe it's overvalued. As of now, the S&P 500's price-to-earnings ratio is around 24.6, significantly higher than the historical average of 15. This suggests that stocks are priced much higher than their actual earnings would justify, a classic sign of overvaluation. Buffett's cautious stance is further supported by other economic indicators. For instance, the Shiller PE ratio, which adjusts for inflation, is currently over 30. This level was last seen during the dot-com bubble in the early 2000s. When this ratio is high, it often precedes a market downturn. Financial analysts also point to the yield curve, which has been inverted for over 600 days. An inverted yield curve, where short-term interest rates are higher than long-term rates, has historically been a reliable predictor of recessions. The current inversion is the longest in over 40 years, signaling potential trouble ahead. So why is Buffett so cautious? It's not just about current valuations. Buffett also considers the broader economic environment. With rising inflation, geopolitical tensions, and supply chain disruptions, the risks are higher than usual. His decision to hold on to cash rather than invest is a strategic move to protect against these uncertainties. Buffett's warning is clear. By not investing, he's signaling that he expects a market correction. His actions, backed by various economic indicators and expert analysis, suggest that we should prepare for potential downturns. As always, Buffett's strategy of patience and caution offers valuable lessons for all investors. Historical context and predictions. Did you know Warren Buffett predicted the 2008 financial crisis years before it happened? That's right, Buffett has a track record of making eerily accurate market predictions, and his warnings often come just before major economic downturns. Buffett's caution isn't new. In the late 1990s, during the dot-com bubble, he warned about the unsustainable valuations of tech stocks. While many investors were caught up in the frenzy, Buffett stayed on the sidelines. When the bubble burst in 2000, the Nasdaq plummeted nearly 78%, proving Buffett's caution was well-founded. Fast forward to 2008, and Buffett was at it again. In 2007, he wrote in his annual letter to shareholders that the world was in the grip of a debt binge, warning that a significant downturn was imminent. The very next year, the global financial crisis hit, leading to a massive market collapse. The S&P 500 fell by over 50%, and many financial institutions were on the brink of collapse. So what does Buffett's track record tell us about his current stance? With Berkshire Hathaway's cash pile at a record $189 billion, Buffett is clearly signaling caution. His reluctance to invest in today's market suggests he sees troubling signs on the horizon. The Shiller P/E ratio, which adjusts for inflation, is over 30, indicating stocks are highly overvalued. This level was also seen just before the Great Depression and the dot-com crash. These indicators suggest that the market is in dangerous territory. But it's not just these ratios. Consider the inverted yield curve, which has been inverted for over 600 days. Historically, an inverted yield curve, where short-term interest rates are higher than long-term rates, predicts a recession. The current inversion is the longest in over 40 years, signaling potential trouble ahead. Based on current data and Buffett's history, a market correction seems likely. His strategic patience, backed by a keen understanding of market cycles, indicates that he's waiting for prices to come down to more reasonable levels. The inverted yield curve. Did you know that the yield curve, a key economic indicator, has been inverted for a record 634 days? That's the longest inversion in more than 40 years, and it's a major red flag for the economy. But what is an inverted yield curve, and why should you care? Normally, long-term bonds pay higher interest rates than short-term bonds because they take longer to mature, but when the yield curve inverts, short-term bonds pay more than long-term ones. This inversion is often seen as a warning sign of an upcoming recession. The yield on the 10-year Treasury note is currently lower than the yield on the 2-year Treasury note. Historically, every recession in the last 50 years has been preceded by an inverted yield curve. Right now, the 10-to-2 Treasury yield spread is at minus 0.93%, its lowest level since 1981. That's a big deal because it suggests investors expect tough economic times ahead. Why is this happening? When investors expect a recession, they move their money into safer long-term investments, driving down their yields. Meanwhile, short-term rates stay high because of central bank policies aimed at controlling inflation. This combination creates the inversion. The current inversion has lasted over 600 days. The previous record was during the 1978 inversion, which lasted 288 days and was followed by a severe recession. The fact that we've doubled that duration is a strong indicator that economic trouble might be on the horizon. Experts use the inverted yield curve as a reliable predictor of recessions because it reflects investor sentiment and economic fundamentals. When short-term yields are higher than long-term ones, it often means that investors are worried about the near-term economic outlook. Warren Buffett is known for paying close attention to such indicators. His decision to hold on to a massive $189 billion cash reserve rather than invest it in the market aligns with the caution signaled by the inverted yield curve. Buffett's historical accuracy in predicting economic downturns adds weight to this concern. Expert opinions and analysis. Did you know that some experts believe Warren Buffett is as bearish as he's ever been? That's a shocking statement considering his long history of market insights. So what are the experts saying about Buffett's current stance and the market conditions? Bill Smead, Chief Investment Officer at Smead Capital Management, stated, "Warren Buffett is as bearish as he ever gets." He points to Buffett's massive cash reserve and recent moves, like trimming his Apple holdings, as signs that Buffett is preparing for a significant market downturn. Other analysts agree the current market conditions, with the S&P 500's price-to-earnings ratio at around 24.6, suggest overvaluation. Historically, a high PE ratio often precedes a market correction. Additionally, the Shiller PE ratio, which accounts for inflation, is over 30, levels seen only before major crashes like the Great Depression and the dot-com bust. In a recent CNBC interview, financial analyst Jim Rogers highlighted that the current inverted yield curve, lasting over 600 days, is a clear indicator of an impending recession. He noted, "When you see an inverted yield curve for this long, it's a strong sign that economic trouble is on the horizon." Buffett's cautious approach is not just about holding cash, it's about waiting for the right opportunity, a strategy that has served him well in the past. Financial expert Peter Schiff echoes this sentiment. Buffett's patience is legendary. He waits for the market to come to him, not the other way around. Buffett's long-term strategy. Ever wondered why Warren Buffett is so patient with his investments? His long-term strategy is all about waiting for the right moment to strike. Buffett's philosophy focuses on value and patience, allowing him to buy great companies at bargain prices when the market corrects itself. Let's look at some historical examples. During the 2008 financial crisis, while others were panicking, Buffett was buying. He invested billions in companies like Goldman Sachs and General Electric at rock-bottom prices. These investments paid off massively as the market recovered. For instance, his $5 billion investment in Goldman Sachs earned Berkshire Hathaway a $3 billion profit. Buffett's strategy isn't just about timing, it's about understanding the true value of a company. He famously invested in Coca-Cola back in 1988 when its stock was undervalued. Today, that investment is worth over $22 billion, showing a gain of more than 1,200%. Over the past 50 years, the S&P 500 has returned an average of about 10% per year, but Buffett's Berkshire Hathaway has outperformed the market significantly, with an average annual return of around 20%. This illustrates the success of his long-term value-driven approach. Buffett's strategy is backed by solid data. The stocks he buys typically trade at a 30% discount to their intrinsic value. This margin of safety helps protect against market volatility and downturns. Thanks for watching, and please make sure you subscribe if you enjoyed the video and watch this one as well.